Imagine you have 10,000 in your hand right now. It's not life-changing money, but it's enough to make a difference if invested wisely. The question is, where does that money grow the fastest? In the United States, in India, or in Canada? At first glance, the answer might seem obvious. Many would say the US because of its massive stock market and opportunities, or maybe Canada because of its stable economy. But then there's India, a fast-growing economy where the cost of living is low and your dollars stretch further. The reality is, money doesn't just grow based on how much you invest. It grows based on the environment you place it in, the market conditions, the taxation, the inflation, and even the currency strength. $10,000 in New York doesn't equal $10,000 in Mumbai or Toronto, and that difference changes the way your wealth builds over time. In this speech, we'll break down the real potential of 10,000 across these three countries, comparing living costs, investments, taxes, and purchasing power, so you'll know exactly where your money works the hardest and delivers the best long-term growth when considering where 10,000 grows the fastest. The first factor to examine is the cost of living and how inflation impacts day-to-day expenses in each country. In the United States, the cost of living is relatively high, especially in major cities like New York, San Francisco, and Los Angeles. Rent, groceries, utilities, and healthcare are expensive, which means that even if you earn or invest money, a large portion of it is absorbed by necessities. For example, a modest apartment in a metropolitan area can easily consume several $100s monthly, and when you add groceries, transportation, and insurance, the expenses accumulate rapidly. Inflation in the US tends to fluctuate, but over the past decade, it has averaged around 2–3% annually. While not extreme, this steady rise gradually diminishes the purchasing power of money over time, which is a critical factor when thinking about the growth of 10,000. In Canada, the situation is similar but slightly different. The cost of living in cities like Toronto or Vancouver is high, particularly for housing. However, day-to-day expenses like groceries and public services are often slightly lower compared to major US cities. Canada's inflation rate has historically hovered around 1.52%, but recent economic shifts have pushed it higher. The stable social safety net, healthcare system, and lower utility costs in some provinces can help stretch 10,000 or further than in certain US regions, but it still faces constraints if invested in a high-cost living environment. Urban centers, while offering more opportunities, demand higher living costs, meaning that a portion of any potential growth is quickly consumed. India presents a very different scenario. The cost of living in India is significantly lower, especially outside major metropolitan hubs like Mumbai, Delhi, or Bangalore. Rent, and food, transportation, and healthcare are all dramatically cheaper when compared to North America. For instance, renting a comfortable apartment in a mid-sized city might cost a fraction of what you'd pay in Toronto or New York, and groceries for a month could be less than the cost of a single restaurant meal in the US. This affordability means that more of the 10,000 can be allocated toward investments rather than daily expenses. Inflation in India has historically been higher, averaging around 4–6%. But even with this fluctuation, the low base cost of living allows your money to stretch much further, giving more room for compounding and wealth growth. It's also essential to consider lifestyle expectations. In the US and Canada, a middle-class lifestyle demands significant spending, from housing to entertainment and healthcare. India's lower-cost structure allows for a comparable standard of living with much less expenditure. This difference doesn't just affect how much money you can save, but also how much you can invest over time. A smaller portion spent on essentials means more capital can be deployed into stocks, mutual funds, or real estate. Even modest investment returns compound faster when the base capital remains higher, free from excessive living expenses. Additionally, the speed at which 10,000 can grow is influenced by how much disposable income remains after managing the cost of living. In the US or Canada, high costs limit the capacity to reinvest frequently. In India, however, the lower expenses and the possibility of leveraging local investments with higher yield opportunities can create a more favorable environment for compounding growth. Even accounting for inflation, the effective growth rate of money can be higher because the real purchasing power and investment capacity are preserved. Understanding these differences highlights why cost of living and inflation are critical first considerations when evaluating the fastest growing environment for 10,000. The interplay between everyday expenses, lifestyle expectations, and inflation directly affects how much of the principal can be saved and invested. By carefully analyzing these factors, it becomes clear that the baseline conditions of each country set the stage for wealth creation, determining how effectively money can work for its owner and grow over time. When evaluating where 10,000 has the potential to grow fastest, the next crucial factor to consider is the range of investment opportunities and their growth potential in the United States, India, and Canada. In the United States, the investment landscape is vast and diversified, offering everything from the stock market, real estate, bonds, ETFs, and mutual funds to more niche alternatives like rise and venture capital opportunities. The U.S. stock market is particularly attractive for long-term wealth growth due to its historical average returns of around 7–10% annually after inflation. With 10,000, Even small investments in index funds such as the S&P 500 and Nasdaq-focused ETFs can generate compounding returns over time. Real estate is another viable avenue, although property prices are high. Certain suburban and emerging city markets still provide rental income opportunities and potential appreciation. Access to technology-driven investment platforms and tax advantage accounts like Roth IRAs or 401ks further amplifies growth potential, allowing investors to maximize their returns through strategic planning and compound interest. In Canada, investment opportunities are somewhat similar but with subtle differences. The Canadian stock market offers reliable growth, particularly in sectors like banking, natural resources, and technology. While the overall market size is smaller than that of the US, it remains stable and offers consistent returns for long-term investors. Real estate is a popular investment choice, but certain urban markets, especially Toronto and Vancouver, have seen prices escalate rapidly, which makes initial capital requirements higher and entry more challenging with just $10,000. However, Canadians benefit from tax-advantaged accounts like tax-free savings accounts, TFS, and registered retirement savings plans, RRSPs, which allow investment gains to grow without being heavily taxed, thereby enhancing the effective growth of money over time. Mutual funds and ETFs in Canada also provide a diversified route to build wealth gradually, but investors need to consider management fees and market conditions when calculating potential returns. India presents a unique scenario that differs significantly from North America. While the stock market is smaller in absolute terms, it is highly dynamic, with substantial growth potential due to the rapidly expanding economy. Indian equities, especially in sectors like technology, finance, and consumer goods, can deliver significant returns, sometimes exceeding those of mature markets, though often with higher volatility. Mutual funds and SIPs, systematic investment plans, provide accessible entry points for smaller investors, allowing even 10,000 to grow steadily through regular contributions and compounding. Real estate in India also presents opportunities, particularly in emerging cities or suburbs around major metropolitan areas where property prices are still affordable and rental yields are attractive. Additionally, alternative investments such as gold, government bonds, or peer-to-peer lending platforms give investors multiple avenues to diversify their portfolios and potentially enhance growth. Currency appreciation or depreciation can also play a role, as investments made in Indian rupees may have differing impacts on wealth growth when measured in global terms, but the high domestic returns often compensate for these fluctuations. The potential for 10,000 to grow is directly linked to how efficiently it can be allocated across these opportunities. In the US, the high liquidity, stable regulatory framework, and access to advanced investment instruments make it easier to grow money steadily, even if entry costs for certain assets are high. In Canada, lower risk and tax efficiency support stable growth, though market size limits explosive returns. India's rapid economic expansion, lower initial capital requirements, and diverse investment options create a fertile ground for higher growth, albeit with increased risk and volatility. Strategic allocation in each country, balancing risk and reward while considering compounding timelines, can significantly affect how fast money grows, ultimately showing that the environment in which you invest shapes not just the returns, but the speed and sustainability of wealth accumulation. Another critical factor when determining where 10,000 grows the fastest is taxation and government policies, as they directly influence how much of your money remains invested and how quickly it compounds. In the United States, taxes can significantly impact investment returns. Capital gains taxes, dividend taxes, and income taxes all reduce the effective growth of money if not carefully planned. For long-term investments held over a year, long-term capital gains are taxed at a lower rate, typically ranging from 0 to 20% depending on income brackets, and which encourages long-term wealth building. Additionally, the U.S. offers several tax-advantaged accounts, such as Roth IRAs, 401ks, and health savings accounts, which allow investments to grow either tax-free or tax-deferred. These incentives can dramatically enhance the compounding potential of 10,000, especially when combined with consistent contributions and strategic asset allocation. Government regulations are generally investor-friendly, providing transparency, legal protection, and a stable financial framework that reduces the risk of capital erosion due to unforeseen policy changes. Canada also provides a structured environment with supportive policies that affect investment growth. Tax-free and tax-deferred accounts, like tax-free savings accounts at TFSAs and registered retirement savings plans RRSPs, allow Canadians to shelter gains from taxes, was particularly beneficial for maximizing the growth of smaller investments like at 10,000. TFSAs, for example, allow contributions to grow tax-free and be withdrawn without any tax liability, giving investors more flexibility and control over their wealth. RRSPs, while providing immediate tax deductions on contributions, defer taxes until withdrawal, which usually occurs during retirement when income and therefore tax rates may be lower. Beyond these, account Canada has a stable regulatory environment that protects investors, ensures corporate transparency, and limits extreme market volatility. However, tax rates on dividends and capital gains outside these accounts can reduce net returns, so careful planning is required to optimize investment growth. In India, taxation and government policies present both challenges and opportunities. The Indian government imposes capital gains taxes on equity, real estate, and other assets, but these rates vary depending on the asset class and holding period. Investment long-term capital gains on equities held for more than a year are currently taxed at 10% above a certain exemption limit, which is lower than short-term gains, encouraging longer-term investment strategies. Real estate gains, on the other hand, are subject to different rates depending on the holding period, which can affect the net profitability of property investments. India also offers investment schemes with favorable tax treatments, such as the Public Provident Fund, PPF, and National Pension Schemes, MPS, which provide tax deductions and compounded returns over time. Additionally, government initiatives to boost entrepreneurship, stock market participation, and digital investment platforms have made it easier for small investors to access growth opportunities while minimizing tax leakage. Currency fluctuations, regulatory reforms, and fiscal policies also influence the effective growth rate, making it essential to align investments with favorable tax treatments to maximize returns. Government policies also extend beyond direct taxation, including inflation control, interest rate management, subsidies, and incentives for certain sectors. In the United States, policies that encourage homeownership, small business development, and retirement savings indirectly enhance investment growth. Canada's focus on financial stability, social welfare, and controlled inflation similarly supports steady wealth accumulation. India's dynamic policy environment, while sometimes unpredictable, often incentivizes long-term investment in growth sectors like technology, manufacturing, and infrastructure. Understanding how each government's policies interact with your investment strategy is critical because even the best performing asset can underperform if taxes and regulations are not carefully considered. By analyzing tax structures, incentives, and regulations in the US, Canada, and India, investors can identify which environment allows 10,000 to retain the most value and grow more efficiently over time, ultimately shaping the pace and sustainability of wealth accumulation. The final factor to consider when determining where 10,000 grows the fastest is currency value and purchasing power, which often gets overlooked but has a profound impact on real wealth accumulation. In the United States, the US dollar is considered the world's reserve currency, giving it high stability and global acceptance. This stability means that investments and returns measured in dollars maintain predictable value both domestically and internationally. The purchasing power of a dollar, however, fluctuates with inflation, and as everyday costs rise, the effective growth of 10,000 can be eroded if returns don't outpace inflation. For example, a stock market gain of 8% in a year might seem impressive, but if inflation rises to 4%, the real growth of that money is only around 4%. Despite this, the strong global position of the dollar allows for easier diversification into international markets and access to a wide range of investments that can compound efficiently. In Canada, the Canadian dollar is less dominant globally but remains stable and reliable domestically. Its value against major currencies like the US dollar can fluctuate, which can influence the real purchasing power of investments for Canadian residents or investors looking to move money internationally. Domestically, Canadian purchasing power is slightly lower than the US in major urban centers due to the cost of living, but it still allows for steady investment growth. When comparing 10,000 growth potential, the key consideration is how much of that money can actually be deployed into investments without being eroded by day-to-day expenses. A lower cost of living outside major cities allows more capital to be invested, while the stability of the currency ensures that these investments retain predictable value over time. Canadian investors can also access global markets, but currency conversion and exchange rate risks can slightly reduce effective growth if not managed carefully. India presents a different scenario altogether. The Indian rupee is not as strong or globally recognized as the US or Canadian dollar, and its value fluctuates more significantly due to factors like inflation, trade deficits, and foreign investment flows. However, the lower cost of living in India dramatically increases the purchasing power of 10,000. What might be a modest sum in the United States or Canada can go much further in India, allowing for higher investment allocation relative to expenses. For instance, rent, groceries, and daily necessities cost a fraction of what they do in North America, meaning a larger portion of 10,000 can be directed toward wealth-building avenues. Even though currency volatility can pose risks, strategic investments in equities, real estate, or fixed income instruments can still deliver higher effective growth when measured against the domestic cost of living. Additionally, the growing Indian economy and rising consumer base create opportunities for returns that can outpace inflation, further enhancing the real purchasing power of invested capital. Purchasing power also affects lifestyle flexibility and reinvestment capacity. In the US and Canada, high living costs limit how much disposable income can be redirected into investment, slowing the compounding effect over time. In India, the disparity between income and expenses allows for a greater portion of the initial 10,000 to be invested, accelerating growth potential. Currency stability and inflation-adjusted returns must be considered together. A strong currency with high living costs may actually reduce effective growth, while a weaker currency with lower expenses can enable faster accumulation of wealth, provided investments are chosen wisely. By analyzing the interplay between currency value, domestic purchasing power, and international exposure, it becomes evident that the environment in which 10,000 is deployed has a significant influence on how fast it grows, shaping both short-term gains and long-term wealth creation strategies.